All right, so once again, welcome back to chapter 10. So if you remember, the very first part of chapter 10 was dealing with accounts receivable. Now, of course, with that, right, 10.2 is going to be time value of money. So in this case, this is more in regards to what happens when I invest in either bank bonds or I invest in, or not invest, but obtain a bank loan. How am I able to predict the future or the outcome of my payments and things like that, etc., etc.? It's called time value of money. Okay. So when we look at money, right, we understand this key factor is that oftentimes money loses value over time, okay? Especially right now, the dollar is very, very weak compared to a lot of stuff just because we have a lot of money flowing into circulation, right? We had, especially during this pandemic, we had a lot of money that was pushed into the system, okay? Now, how usually inflation or recessions or anything like that, how is it determined the change in value over time? Oftentimes, it's just due to any type of critical events that happen in the United States. So oftentimes when there's a depression, a recession, or even an economic uplifting, those usually determine whether money is pushed into the system or money is being taken out from the system. So right now, as you know, the dollar has definitely lost its value drastically in the last couple years, right, with the pandemic. It's already September of 21. Do you believe that? It's already, the year's almost over. And yes, the dollar has definitely stretched upon its time. So right now, back then, 20 years ago, if you remember, 20 years ago, a dollar can actually pretty much go pretty far. You know, chips or anything like that, food itself was literally pennies. And now look at food. Food is quite pricey, right? It's about like $4 or $5 for a regular bag of chips. And that's just a determining factor of how much the dollar has grown, right? But that means we need to consider that when we make predictions in the future, that means we need to assume that because of these extra outcomes or extra features, we need to take inflation or inflation or something like that into consideration. Okay, I think it's Nancy. There she is. Okay. So once again, when we're taking a look at the dollar, especially in the United States, it has definitely changed over time. And you can't actually figure out how much the dollar is worth right now because if you go to the Google website, you can actually compare how much the dollar changes based on a day-to-day basis. So you can actually check it out. You can see that how much the dollar changes in per day. Okay. So like right now, it's definitely changed, right? And when we make predictions for the future, we need to understand that inflation is a possibility, right? Our dollar will definitely be a lot more worth it later, okay? Now, in this case, right, we're going to be looking at two different types of ways that we can calculate time value of money because the assumption here is that we need to assume that even though a dollar today is going to be a dollar, but in 20 years, how much is that going to be worth? And this is where we're going to be introducing to what's called interest. So when we does do something like a savings account or just seeing how the dollar just becomes in 20 years, this is exactly how we are able to determine it by two different factors, right? We have simple interest and then we have compound interest, okay? Now, again, interest earnings, okay, are usually from the bank bonds, and that's what we're going to be focusing on today, is any bank bonds or any notes receivable, or if anything, we have like some kind of savings account. Now, again, like that's just usually common when it comes to starting up a company, but a more common one we're going to take a look at is actually a loan, okay? And we'll talk about how we calculate loans and how much interest is going to be collected and so on and so forth in a couple slides later, okay? But right now, we're going to focus on two criteria, which is a simple interest and a compound interest, okay? So here, simple interest, right? It's usually when interest is only calculated once, meaning you're going to have a lump sum of money and you're going to calculate the interest only once. So common examples of simple interest would more or less be something like a bank bond, okay? Where you invest money and at the end of X amount of years, that's what you claim at the end of 5 years, okay? So in this case, what are the key components of how to calculate simple interest, okay? You definitely need P, which is your principal, which is going to be your original investment, right? You're going to need I, or in this case R, for your interest rate, right? And usually interest rates are more likely to be an annual percentage rate. Okay, that's what APR stands for, right? So in this case, we're looking at interest on a year-to-year annual basis, unless it's specified saying that maybe it's not compounded every year, right? Unless the annual percentage is per month, okay? But oftentimes, like I've mentioned before, right, most of the times when you see a percentage, it will most likely be an annual percentage rate, okay? And of course, we're going to also talk about the time, all right? Because annual percentage rates are typically in an annual type of ordeal, that's exactly how we count time. We usually measure in years, okay? Now, of course, unless specified, let's say you do a short-term loan or a short-term bank bond, then yes, it could be less than a year. And then what we have to do is just figure out the numbers compared to 1 year, okay? Or what's equivalent to, if it's 6 months, right? That's equivalent to half a year, okay? So we do need to figure those extra numbers out. Okay? Where compound interest, it's more along the lines of something that, again, credit card companies, they are on a compound interest, meaning they don't care if it takes you a year and let's say you owe them X amount of money and they say that, well, you can make monthly payments. Then, therefore, they're going to charge and calculate your interest rate every month, okay? So, again, your interest rate, if it's per year, then what I mean by this is that every month they're going to calculate a small percentage, right, to reflect how much interest you're going to accrue every single month. So that means compounded, depending on what the context is, whether it's monthly, weekly, quarterly, or annually, right, will determine how many times you need to recalculate the interest rate to determine how much interest is going to be collected every bill payment period, right? But in this case, like I mentioned before, a great example would be a credit card, right? Credit card companies, they get you through the interest because realistically, they think that a lot of times that people who borrow credit cards, like it's easy to spend all the money, but paying it back is the hard part. And the way that they get you and make money off of you is that they charge you interest every single month, and what they do is instead of you making a payment to your credit card, they make you pay the interest first and then the credit card comes after. All right, and we'll talk about that when we dive into loans. All right. So once again, in this case, it's the same exact components except there's one additional component, and that is n, which is the number of times compounded. All right, which means how many times are you going to be calculating interest? All right, so let's go ahead and take a look at our very first one, which is simple interest. Here is the equations and here is the formula, okay? The equation is going to be interest is equal to principal times rate times time. So in this case, a best way to memorize this is pretty, right? PRT equals I. Pretty. All right. And then, of course, the second formula that we have here is to determine future value, which is your principal plus your interest. Okay. So once again, this is where when we're calculating the amount of interest, we only calculate it once. In this case, it's one time in the amount of years that is assigned. So in this case, let's do an example here. Right? The example says that you bought a bank bond for the total amount of $100,000, okay? The interest rate here is 6%, and it is to be redeemed at the end of 5 years. So then, of course, you know bank bonds, right? You cannot... Those are the kinds of securities that you can't take out early, right? It's not like a 401k plan or it's not like a savings account, right? There are restrictions on the amount of, if you buy a purchase or have a bank bond, right? It has to yield its until it's retired. And when it's retired, then you can choose to either redeem or collect the money after the time period. Okay, so in this case, it's redeemable at the end of 5 years. So here we have the three key factors, which is 1, your principal, 2, your rate, and 3, your time. So again, we understand that we take this information and we place it into, so we can plug our numbers into each formula or each variable. So our principal here is, what was my original investment? In this case, it was $100,000. And my rate was 6%. Of course, when we're doing math or calculations, we need to convert our percentage into decimal points. So in this case, 6% is equivalent to 0.06. Okay? And then, of course, time is already in years. So in this case, my time I'm looking here is 5 years, right? Because it's redeemable in 5 years. Okay? So let's go ahead and take a look at our first equation here, which is to solve for the interest that I'm going to collect in 5 years. So principal times rate times time. So principal, which is 100,000 times 0.6%, which is the rate, times 5 should give you a total of $30,000. Okay? So 100,000 times 0.6 times 5 equals $30,000. So then our next step is, how do we solve for the future value? The future value is going to be your principal plus your interest. So in this case, it's going to reflect as your principal, which is the 100,000, plus the interest, which is 30, to give you a total future value of $130,000. So that means at the end of 5 years, you've earned $30,000 worth of interest. So that means your original investment of $100,000 has now increased to $130,000. Okay? Now, in this case, that is actually a lot in regards to the span of 5 years, right? If you divide that by 5 years, it's about $6,000 a year, which isn't a bad number to begin with, okay? Now, of course, with that being said, right, Sometimes you need to look at the bank bond and determine, or what the criteria is, right? What's the amount of percentage? What is the available allowable time for you to collect it? What is the best way to be able to produce more money quickly without having to reserve it for 5 years? Okay, there's many, many options you can do, and this is how you are able to determine how much money you can make by just doing the simple calculation. Okay, so that's simple interest. Any questions?
No.
Okay, so let's talk about compound interest, right? So here, this is where the calculations are going to become a little more complicated, right? Because with compound interest, what this actually does is that it takes the interest, right? And how are you going to solve for interest? The interest is going to be the future value minus the principal. So in this case, we need to solve it backwards. So instead of solving for interest, you're going to solve for future value first. All right. And the formula for the future value is going to be principal times 1 plus rate over the number of times compounded, parentheses, up to the n, which is the number of times compounded, times time, power. Okay. So again, if you look down below, that's what it should look like. So what you're actually doing is you're taking the rate and you're adding 1 to it, and you're multiplying it amongst the amount of years because it's being compounded multiple times throughout 1 year. In this case, let's determine this in this example. So the same exact scenario, except you have one key extra information. So in this case, right, you bought a bank bond for $100,000, right? The interest rate is 6%, and it's to be compounded quarterly, meaning every 3 months it's going to be calculated with interest. Okay, so in this case, you definitely want to know how to calculate this, because this will definitely be an awesome tool for you to know for when you are wanting to plan to either open up a bank loan. At least you're able to figure out these numbers yourself and figure out how much interest you're going to be paying, and etc., right? The usually rule of thumb here is you always want to aim for a lower interest rate, and you also want a shorter amount of time to pay it. But with that being said, it depends on how much your original principal amount is, right? If you owe a huge lump sum money, then that means if you're getting a shorter payment frequency and you get a lower interest rate, you could be paying a lot every single month. Okay, so you do have to understand that as well. Okay. So here we have everything that we need, right? Our principal is 100,000, right? The rate, same thing, is going to be converted into decimal points, so 0.06. Here, because we determined that you're going to be compounded quarterly, that means every 4 months you're going to be, or in this case, every 3 months you're going to be compounded, right? If you think about it, a year splitting into quarters, you're going to have 4 times the amount that's going to be calculated. And once again, you have a span of 5 years to calculate all of that, okay? So with that being said, we need to focus on our formula here, which is going to be the principal times 1 plus r over n, close parentheses, up to the nth and 10 times time power, okay? So once again, I'm going to break it down to you a lot more easier. And this is how we're going to be able to plug it into Excel. Unfortunately, you do need to have if you're doing this on a calculator, you do unfortunately need to have some kind of graphic calculator or a higher model than a regular 89 Ti scientific calculator. You need to have something that's able to do a exponent key function, okay? In this case, right, we have the best type of program out there, which is Excel. Okay, Excel, you are able to type in the same exact formula and be able to figure out what the future value is. So in this case, on Excel, you do need to be very, very cautious because Excel is very sensitive to formulas, right? And the best way to make sure that it does calculate it in the exact order of operations, you do need to use parentheses, right? Because Excel is very straightforward. If you say 5 times 4, it will give you 5 times 4 equals 20. But if you say you want 5 times 4 plus 2, it's going to multiply first and then add second. All right, not add and then multiply second, okay, because of the whole rules of math, right? So if you guys remember PEMDAS, which is parentheses, exponents, multiplication, division, adding, and then subtracting, that's exactly the same context here in Excel. You need to be very specific on exactly what you're calculating. So in this case, we're going to be using parentheses. So most cases, it's usually easier if you do your principal times open parentheses 1 plus open parentheses r divided by n, close parentheses, caret, open parentheses, n times t, close parentheses, okay? Now, what does the caret do? Caret is going to be your symbol above your number 6 key. Okay, so you have to hold shift 6 in order to activate that key component right there. So you definitely want to be sure you have enough space for this formula to happen, okay? And you want to make sure that you make sure that every time you use an open parentheses, you have the equal amount of closing parentheses, because sometimes, once again, if you make a typo or make an error, Excel will let you know, okay? So in this case, I'm going to take my principal of 100,000, I'm going to multiply it by 1 plus the rate of 0.06, which is being divided by 4 because it's divided by n. And then I'm going to close out parentheses twice because there's 2 parentheses, right? And then, of course, I'm going to bring it up to the 4, which is the n times time power. So in this case, right, because I'm not showing you for this example here, that's what's going to come out to. And when you press enter, it should result in $134,685.50. Okay? And of course, with that, when we want to try to solve for our interest, right, we take our future value minus the principal to get us a grand total of interest collected to be $34,685.50. So compare and contrast, right? Looking at the difference between simple and compound is that there is a lot of difference, right? Because the difference here is one is being multiplied by the interest 1 time, while the other one is being multiplied 4 times. Okay, so that's the difference there, right? Everyone have any questions?
No, it's okay.
No? Okay. And now let's journalize this transaction right here, right? When we finally purchase our bank bond and now we're going to redeem it, right? We're going to go ahead and figure this out. Well, we're going to buy the bank security in the first place, right? So this is what we're going to do. We're going to purchase it. So we're going to do checking, and then we're going to buy the bank bond for $100,000, right? But in this case, because we have the piece of information saying that we have the interest rate of 6% and it's being compounded quarterly, this is how we redeem our bank account or our bank bond, right? you're going to end up receiving cash, so you're checking, and this is what's going to happen is that you're going to have your original investment of your bank bond for the 100,000, and of course you're going to calculate the amount of interest that you're going to be collecting, and that's going to be considered interest income because you've earned extra money by leaving money in a vault and letting it accrue interest. So in this case, right, two separate things that we need to recognize here is you need to recognize one for the expense account of the interest, and then of course you need to calculate the amount of original principal you can take away from your actual calculations here. Okay. Any questions? Okay.
No.
No questions?
No.
All right. So let's talk about how interest is actually calculated, especially compound interest, right? How in the world is it going to be calculated? So in this case, right, oftentimes, especially when we're looking at compound interest, okay, this is actually how you're able to calculate it on an actual worksheet, right? So we're going to take an example of a bank bond or a bank loan, or a credit card loan, whatever you want to use, right? And I'm going to show you how to compound something, right? So in this case, how to calculate, you're going to know how much to calculate the interest that you are collecting. You're going to calculate how many payments are going to affect the actual principal. And of course, again, like I mentioned before, right? Oftentimes, little does a lot of people know when it comes to making deals with banks about borrowing money is that there is a fine print there that allows you to sign an agreement that are you going to pay all the interest first and then start paying towards your principal, or as you collect interest, right, then you're going to make a payment towards to a portion part of the interest, and then a portion is actually going to go to your actual principal. And this is how we are going to calculate it. Okay? So I'm going to apply this to a bank bond. So here's the example here, right? So then on January 5th, okay, you borrowed a bank loan for a total of $10,000, okay, and it has an interest of 4.75% APR, and of course it also is compounded every month. Okay, so monthly, and again, the bank approves this loan and expects to be paid back in 5 years. So here we have the key factors here is that we have our original principal of the $10,000, we have the interest rate of 4.75%, and we have the compounded, which is every month, which is 12 times, and again, we also have the key factor that this loan is meant to be paid in 5 years, right? 5 years times 12 months gives you a total of 60 months to pay off the entire loan. Okay? So of course, first what we're going to do is we're going to recognize that we borrowed money by saying, well, if we borrowed money, that means we have cash flow. So in this case, I'm going to borrow a bank bond for $10,000, and here is my checking that I am going to get a $10,000 increase into my checking account because I borrowed money. Okay. So here's the table that you're going to set up is that, well, let's do a month-to-month criteria where we're looking at how much interest is going to be collected and how much it does when we make a payment. Now, in this case, right, we determined that on January, right, that we got a $10,000 loan. And of course, usually the first month, right, you never accrue interest. You only accrue it after the first month, right? When you actually start owing the money. So in this case, I owe $10,000 and that is it. And usually interest rate for the very, very first month doesn't exist because you didn't use it. You didn't spend it. You just borrowed the money. So in this case, you will not accrue interest until the following month, right? When 3 days has actually passed. So in this case, right? So my interest rate is nothing. My interest expense is nothing. And my current balance is still $10,000, okay? So that means the next time that the next month rolls around, this is where it's actually going to be starting to calculate interest, okay? So here's the scenario here. Let's go ahead and actually calculate that interest because now it's a month has passed by. So now we have actual information that we can use to actually calculate our total amount. So our principal right now is still $10,000. Okay, right? Because in the month of February, I only borrowed $10,000. So therefore, that is the full amount that I owe for February. Okay? Now in this case, my annual percentage is 4.75%. Right? In this case, that is an annual percentage. To actually get a true reflection of how much interest you're going to be collecting per month, you're going to take that annual APR, right, because it's an annual rate, and you're going to divide it by the total of 12 months. So in this case, boom, it's going to be 0.003958 as the percentage you're going to calculate per month. And straightforward, right? In order to solve for how much interest you're going to be collecting, you're going to multiply the 10,000 by the 0.003958958, okay? To get you a total of $39.58, okay? And once again, that's going to be tacked onto your current balance of $10,000 to get you a total of $10,038.58. And now the question is, how much are you going to actually pay or make a payment to? Okay? So in this case, right, my new account balance is now not $10,000, it's $10,039.58 because that is the interest that had accrued on this actual bank loan. Okay? So what I'm going to do is I'm going to go ahead and make a payment, a random payment of $187.57. So let's go ahead and take a look at how we're going to journalize that, because now when we actually are making a payment to our credit card, like I mentioned before, you need to know that you're making a payment to your bank loan, but at the same time is often cases 100%, and this is how the banks make money, is that usually when you pay a portion of the money, immediately it's going to go straight to the actual interest. So what you're doing is you're paying off your interest, and whatever's remaining is going to actually go towards your actual principal. So in this case, if I'm making $187.57 worth, right, by calculating this amount right here, $39.58 was already the amount that I calculated for the monthly interest that I will be collecting. So in this case, I paid $187.57, and a portion of that money, right, $39.58, actually goes towards my actual loan as well, and then everything after that is going to go towards your actual loan. So in this case, right, my principal, I'm only paying $147.99 worth to my actual principal. So they always say if you could pay more, then at the end of the day you could pay less. But who's going to be able to, who's going to be able to carry all of this and, all this interest and having to calculate it and making sure that when you actually make a payment to your credit card, it's actually going towards the interest first and then it goes to your actual loan itself. So in this case, the loan, right? Oftentimes, this is what a lot of people say is that they always open up the bill and it seems like their bill is never decreasing. And that's true about understanding how bank loans work. You're 100% going to pay for the interest first, and anything that's in excess will go towards your actual payment. Okay? Okay? Any questions here?
Nope.
Okay. So, of course, when we apply our payment of $187, right, therefore, our new balance is going to be now for $985,852.01, right? Because I end up paying 57 cents when I owed 58. So in this case, right, no matter how many times I calculate how much interest there are, at the end of the day, that's how you're going to calculate at the how much it's going to cost you to get calculate all the interest to get you your new ending balance at every single time. So in this case, right, we're slowly decreasing our bank loan, but in reality, we're trying to get rid of it a lot quicker. So in this case, right, so here we're going to be doing another cycle for March, okay? Because now, after calculating that amount here, now we have a new account balance, which in this case, when we learn about a compound interest, they don't care what your original principal is. They're always going to take your outstanding balance. So in this case, I have an outstanding balance of the $9,852.01. And again, you're going to repeat the process over again. You're going to take your annual percentages, divide it by 12 to get you your annual percentage of the 0.03958, right? Multiply those two numbers together, you're going to get a total of $39 and $39 even, right? And of course, that's going to change the amount that you change your dad's, bank. It's going to change the amount of your current balance, okay, from, again, by increasing it from your original principal, which is the updated amount, right? And now it's going to collect and add together to then become a new total balance of $9,891.01. And again, because this number here, right, was already a pre-calculated number. The bank already figured out all the numbers for you, and they send you a bill and say, hey, this is how much you owe me every single month. That will meet me exactly at 60 payments, and you will pay off your entire loan that way. So once again, right, we just collected now more interest. We have a new current balance, and again, we're making another payment. So again, same thing's going to go forth, and that's exactly how compound interest is calculated on a month-to-month basis because it's compounded monthly. So in this case, right, at the end of the day, we will always end up paying the interest first, and then whatever is available actually goes towards the principal. Now in this case, yes, if you want to, you can pay the loan a lot quicker, right? By figuring out how much money you need to pay. And on top of that, your second payment, right? Once you make your first payment, right, that covers the interest, then you have the second option to pay your second portion towards your actual principal. You don't need to pay interest anymore because that should have covered it through your first payment. Okay, so understand that. So that way, this is how you're able to pay off your loan a lot quicker, is that you need to notify your bank, hey, this is my second payment. I'm paying X amount. You can't charge me interest because I've already paid for the interest. Okay, so in this case, that is how you are able to calculate the amount of interest and break it down to see how it's calculated every single month. Okay. Any questions so far?
No.
Right.
No.
Okay. So that was how to deal with a loan. All right. So that is all of chapter 10.2. So here I'm going to dive right into chapter 10.3 since we're already here. 10.3. All right. And this time we're going to take a look at a bank reconciliation. Okay. Now, oftentimes, right, when we take a look at a bank reconciliation, what we're essentially doing is it's basically a list of all the transactions that occurred that's involving either your bank account or credit card, right? So in this case, this is a great way to keep track of all of your expenses and all of those payments that you've made, any paychecks, etc., whatever means that you had to use a bank account for to either pay for things or deposit money into the checking account is going to be how we utilize the bank reconciliation, right? As we know, oftentimes when businesses do in fact use checks, and again with the notion that not all checks are going to be deposited right away, because again, the day that you print out that check or you write that check, you cut that check out, the opposing or the person who's receiving the check has 6 months to deposit that check. So that means, with that being said, and normally too, it does take about 2 to 3 business days for a check to clear regardless. So with that kind of notion in your head, it's always good to make sure that you double check your work and make sure that the opposite person who's on the receiving end received their payments and that they recognize that a service has been completed. Okay? So again, and when you do realize that, right, and let's say the other vendor who received your check decides to not deposit the money, then you can go ahead and also confirm with them saying, hey, give them a call and say, hey, did you actually receive my payment yet? Because I sent you the check about a week ago and my bank account has not cleared it yet. So that's also other means to keep track of whether that check became lost, someone interfered it, etc., or you actually forgot to mail it out. Okay? There's many reasons why we reconcile a bank, and usually commonly you would most likely do a bank account or a credit card account, okay, to keep track of a lot of your transactions. So in this case, so we talked about check, right? We understand that there are 5 components to making a check valid, right? You need the person's name, and the most important thing is going to be the date that you are going to allow this person to cash out. So again, you can put a date in advance. So most paychecks, right, usually are available on Fridays. Sometimes you can get it as early as Wednesday or Thursday, but you can't cash it out or you can't redeem the check until the date it's available. Okay. And of course, you have the account information and so on and so forth. And again, with the idea that the person who's on the receiving end, if they don't do their diligence and deposit the check right away, therefore in your bank account, it will not show that that check was cleared, did not clear at all. So that's why it's best that we try to keep a good track record by completing a bank reconciliation. So here are the things that you do need, okay? So again, if you are using a check to keep track of most of your expenses or what kind of means of making payments, okay? You can have a check register, okay? Where it's literally a book, right? So if you ever written a manual check, right, you have that little tiny booklet at the very top of the little slip there that allows you to keep track of your accounting. It basically gives you, it's like a miniature ledger on there. So then when you cut the check, at least you know exactly who that check went to, when did you check it, what check number it was, and how much you wrote that check out for. So that's the same thing here, is that you will need a check register. So here I have a list of all the checks I've written out and for what the amount is and who I wrote it out to and what date I had it written out for. Okay? Second thing that you're going to need is going to be an actual copy of your bank statement. Now, again, this could be something that you can request. It's pretty easy. You just go to the bank and request a bank statement. Okay? Usually it happens at the end of every single month, which is perfect because most accounting periods out there are on a monthly basis, right? It's a perfect way to measure profitability. Excuse me real quick, okay? Okay? So again, a bank statement is going to give you a list of all of your transactions that happen within that month. And most bank statements usually have an ending date of the very last day of the month. Okay? They usually send out monthly statements, or what you can do is you're able to easily access this through your online banking. Okay? So with that being said, this is a copy of a bank statement, right? It has all the information of how many checks have cleared, how many deposits have actually cleared, and if you were how much interest you've collected, as well as all the bank fees that you had to encounter. Okay. And of course, the last thing that you need to have is your own cash ledger or checking ledger, whichever one that you use to keep track of your actual cash flow in either your checking account or your cash account, whichever one you name it, right? In this case, I use cash ledger, okay? But this is your checking account, right? So in this case, this is what you do on your end in regards to accounting, right? Keeping track of how much money you actually have in your bank account, or what you should have before you cut another check out, right? This is your way of keeping track of your whether you made a deposit or whether you wrote a check out or for whatever expenses that you made. This is giving you a heads up on how much money you should have in your bank account at all times. Okay, so in this case, right there, all right? List of all the transactions that happened that month. So let's actually talk about how we compute or do our bank reconciliation. So again, there are two things that we got to do, right? We need to compare our bank statement to our cash ledger or our checking account ledger, okay? So one is actually a printed document from your bank, and one is your own accounting books, okay? Now the rule here is that we need to understand, what does the bank know that you don't know, right? And vice versa. What do you know that the bank doesn't know, okay? So for example, right? The bank knows that they charged you money because you wrote a bunch of NSF checks. However, on your end, did you know that? No, you would only figure that out when you get your bank statement because it will tell you that you got charged X amount for all of these fees and this is how much interest you've collected. Okay? Vice versa, where what does the bank know? What does the bank not know that you know? So in this case, right, I know I wrote all of these checks and then I know I made all of these deposits. However, the bank says, oh, I only recognize these so far, right? Because we have the idea where there's always deposits in transits or there's always checks that are outstanding, okay? Deposits in transit means usually if you make deposits on a weekend, right? The bank doesn't open on the weekend, so therefore it will not clear until the next following business day, which is always going to be 8 o'clock a.m. on Monday. All right. So if you use a digital app to deposit a check over the weekend, Friday at 6 o'clock, the banks are closed. So by that time, therefore, that check will not clear until the following Monday, which is a business day, starting at 8 o'clock, and they don't put it in right away. They process it. So again, processing any, whether it's a deposit or a check, right? If the person has actually deposited their check and they're trying to clear it, it usually takes anywhere from 2 to 3 business days, okay? Depending what day you actually put it in. Now, again, if I received a check on Monday and I deposit it within 8 to 5, right, regular business hours, that check should be there by Tuesday at 8 a.m., okay? It just depends on the day that you deposit, especially if you do Tuesday at midnight, or I'm sorry, Tuesday at 10 o'clock, it will not process until Wednesday, and you will not have your money until Thursday the following day. Okay? So again, it takes anywhere from 2 to 3 business days for something to clear depending on the day. All right? So with that kind of understanding, right, if we understand which side knows what and which side doesn't know what, then that's where we're going to determine each contributing factor, right? So if I'm looking at my bank side, right, since the bank doesn't know how many checks I've deposited or how many checks that I wrote out that are outstanding, right? Therefore, that's the main purpose, right? We're going to start out with your original ending balance in your bank account. And what you're going to do is you're going to add any money that is in transit, so deposits in transit, and then you're going to subtract out any outstanding checks that have not cleared yet. Okay? And therefore, you should get an adjusted ending balance. Okay? Whereas on your cash or check ledger side, okay, this is where we understand that here that we're going to start with our ending balance in our check ledger account, and we're going to add any interest that we've collected, and we're going to subtract any fees, because again, the bank's not going to tell you that you got charged this. They're going to take it right away from your checking account without even letting you know until you receive the statement. So in this case, it's an automatic deduction from your checking account, and what you need to do is you need to make sure that you update your checking account with the appropriate account information. Okay? So let's go ahead and take a look at the very first side, which is I'm going to go ahead and do the bank side. So first thing you got to do is you got to figure out what the ending balance in your bank account is. So oftentimes when you look at your bank statement, it should tell you at the very top saying you have your beginning balance, right? Which is, in this case, which is April 30th, okay? Or in this case, it'd be May 1st, right? April 30th, the last time. And then it says right here that the ending balance as of May 30th, okay, is May 31st is going to be $9,446.40. So you take that number and you're going to plop it right there. Okay, so that's what I'm going to start my ending balance with, which is the $9,000 in the bank account. Okay. Now, first I'm going to do is I'm going to add any deposits in transit. So what you're going to do is you're going to compare your bank statement to your cash ledger, right? And what you're going to do is you're going to verify which deposits have cleared. Now, most cases and oftentimes, what you're going to notice is usually if you are at the end of the month, that's usually when your deposits will not clear, because the assumption that it takes 2 to 3 days to deposit money, right, it's going to take time to clear. So in this case, right, we're going to run through our check cash ledger with our statement and check out and figure out what numbers that we're missing. So in this case, deposit slip number 421, 422, 423, 424, 425, 426, and 427. Right, let's look at the bank. The bank has 21, 22, 23, 24, 25, 26, but does not have 27. Why? It's because you submitted it on the last day of the month. So therefore, it's not going to appear on the bank statement on the last day. It's going to clear the next day. So in this case, therefore, I am missing deposit number 4427 for $254.52. So that's where I'm going to pop it in here, because the bank has not cleared this amount. So therefore, this amount needs to be added, that amount, because I've already made my deposit on my end, but the bank hasn't recognized it yet. Okay? That I should have more money than what's showing right now. Okay? So next is going to be the outstanding checks. So this is where you're going to compare your bank statement with your check register. Okay? So again, the check register is a list of all of the checks all the checks that you have, all the dates, and all the checks that you've written out. So in this case, right, I wrote check number 125, 126, 127, 128, 129, 130, 31, 32, and 33. I wrote a total of all those checks. Now let's take a look on our bank side, because again, the rules on this is it's not when we send the checks out that the money disappears from our checking account. It's when the other person who receives that amount deposits it into their bank. So in this case, right, let's see which checks have actually cleared. In this case, in my bank statement, tells me that check number 125, 126, 127, 128, 129, and 131 has cleared. Now in this case, right, how can all of those clear? Right? And except for check number 130 and 132 and 133. So therefore, I have a total of 3 checks that have not cleared yet, because due to it's in transit, or the person who received it did not deposit the money yet. So in this case, I'm going to copy all 3 of those checks in for those total amounts, right? To give you a total of $2,216.96 that is not taken out from my bank account. Okay, so therefore we're going to subtract all of this amount, because in context, right, it's money that we already spent, right? We're just waiting for the other person to receive it on their end to deposit it into their checking account. So in this case, you're going to do the calculations, right? You're going to take your ending balance, you're going to add your deposits in transit of $254.52, and you're going to subtract out your total number of outstanding checks for $2,216.96 to get a grand total adjusted amount of the $7,483.96. Okay? So that's just figuring out the bank side. Now we need to figure out what it is on our books to compare and contrast. And the end goal here is that at the end of the bank reconciliation, we must match our adjusted account balances on both the bank and the cash ledger account. Okay, so that means my book and the bank's books must match. So in this case, right, let's start on the right side where we need our ending balance in our cash ledger account. Now, how do you determine what that balance is? It's going to be in this case, it's a ledger. So you're going to have your account ending balance on the very, very right side of the column over here. It's going to be your ending balance in your cash ledger account. So in this case, I have currently right now $7,338.96 as my ending balance, and I'm going to pop it in right there. Okay. Now, of course, what we can do here is going to be interest income, right? So when you set up your bank account, you can set up extra fees and extra income that you can collect when a person decides to either electronically funds transfer you an amount, or if they use a credit card payment, or like they paid their credit card, right? The interest that you can collect on top of that, because again, when you set up a credit card account or letting your customers allow you to owe you money, right? There's a certain percentage of interest that you can charge on them, because essentially what you're doing is you're acting like you're the lender and letting them purchase stuff for you. So you're going to charge them interest on top of that. So that's exactly what that interest is, right? And when we take a look at our bank statement, here it is at the very bottom, right? We have interest, and usually it will tell you how much interest you're collecting. And again, we have what's called an ACH, which stands for an auto clearinghouse, which usually is determined by EFT. So electronics funds transfers, when something clears, usually it's a convenience charge, and because of the convenience of you using electronic funds transfer to transfer money from one account to another, you can set up where the bank does charge the customer for the convenience of sending money electronically. And that's what an auto clearinghouse is, okay? So here I've collected so far $15 worth of interest and $215 worth of auto clearinghouse. So again, that's the two things that you're going to plug in here to get the total of $230 that you're going to be adding back, because that is money that you've earned by charging your customers extra additional money on top of that. Okay. And of course, the less that you're going to do is going to be the fees. The fees is going to be anything that you got charged that the bank automatically took away from your bank account. So a typical one is going to be in case you have any service charges, okay, for helping you run your business, of course, you have to pay some service charges, okay? For example, if you purchase checkbooks from them, that's going to be considered a service charge, okay? Anything that's extra that the bank usually charges you for, okay? Other things could be NSF. Now, NSF is a popular type of fee that you'll encounter. So oftentimes, if you ever gone to an actual bank account, so for example, I use Bank of America. If I ever were to either withdraw too much money or overdraft my bank account, I automatically get charged $35 for overdrafting my bank account. That's the same thing here, is when you have a non-sufficient funds, which is what NSF stands for, right? Non-sufficient funds. When you pull too much money out of your bank account, you get charged automatically a flat rate. And of course, you owe the money that you are owing, right? So in this case, it's a simple rule that the bank has that you need to follow. So in case you do overdraft your bank account, right, it's selective based on each bank account. And in this case, right, I'm going to get charged a total of $35 because I got an actual return check fee. So again, any bounced checks would also cause your bank to send out an extra charge for that. Okay. So again, here I have a return check fee and a service fee of $50 and $35, giving you a grand total of $85 that you have to subtract. So once again, when we're taking a look at this, we're going to start off with our ending balance of the $7,338.96. We're going to add our interest in this case, which is $230, and we're going to subtract our fees, which total up to be $85, to get me a grand total of $7,483.96, which, boom, both my bank and my books both match. And that is how you complete a bank reconciliation. Okay. Any questions?
That's gonna be the only example, or you're gonna do another one?
We will do an example. What I actually mistaken is I was supposed to do the chapter 10.2 exercises and then go to break and then do this part. So that's my fault.
That's okay.
Okay. So of course, because the bank obviously charged me the money in advance, I need to update my books as well by accepting that I had some interest income, but at the same time, I also had to pay some bank service fees from my checking account. So that's what you got to do at the end of the bank reconciliation, is you do need to update your books so it does reflect that these things did happen. Okay? And once again, here is a quick and easy way to memorize bank reconciliation, okay? When you're dealing with your bank, think of it as your dues, right? Your deposits and transits and your outstanding checks. Whereas when you look at your check account or your cash account, think of it as your ifs, right? All your interest and all your fees. And that's the best way to be able to remember the bank reconciliation. As long as you know the banks are dues and your side or your cash is going to be your ifs. Okay, so when you're dealing with the bank, it's your dues. If it's the cash side, it's your ifs. Okay, and remember at the end of the adjustment, they need to equal the same amount at the end of the day, right? And of course, here, when we take a look at our interest, right, we have two types of interest, simple and compound. The formulas are there, and I even inserted an Excel formula for you in this PowerPoint. So instead of having to memorize it, you have it here, right here in this PowerPoint. Okay? So let's go ahead and take the next 20 minutes or so to complete the chapter 10.2 exercises. So dealing with time value money, so we can get practice for the simple and the compound interest. We'll go on break and then we'll continue with the bank reconciliation. Okay? So let me go ahead and stop this recording so at least we have the exercises as